What is up, guys? So I'm going to be recapping this week. We know the Federal Reserve went ahead and cut their federal funds rate by 50 basis points. But then we saw interest rates actually jumped up. So everybody's questioning, asking why. The answer truly lies in the bond market. We know the 10-year treasury yield and 30-year mortgage rates really kind of coincide since 1970s, and they generally really trend at the same time. If the 10-year is usually moving positively, so is the bond market. So bond market, again, it's not old or slow or anything like that. It actually moves very, very quickly. And it goes off of the 10-year treasury and mortgage bonds. So again, the lower the anticipation is with the Federal Reserve rate cut, we will simultaneously always see a faster cut when we start looking at interest rates, okay? I've said this a lot of times on my podcast. The key that we really need to know when we're understanding mortgage rates and we're trying to stay on top of this stuff is to focus on the labor and economic data, not just rate cuts. We know that jobless claims came out this week, and it was actually dropped to the lowest it's been in 4 months. The 10-year at one point actually went to 3.6%. Then we also saw housing starts and permits actually came out. Housing starts beat estimates. It's a good thing. Single family permits also went up, which is likely directly tied to interest rates. We also saw that the 10-year was already higher. So remember, when the 10-year is higher, that usually means that we're going to see a little bit of fluctuation within interest rates. Now, the growth of housing permits, again, is a good sign, okay? That means that we're going to start seeing a little bit more inventory and new builds start to come out, okay? And interest rates have been falling truly since June, right? Because we've been seeing that fluctuation with inflation and employment, okay? It's really hard for us to have the same conversation if interest rates were really close to 7.5% or 8%, like they were at one point around October, November of last year. So again, the bond market usually moves quite quicker than the Fed, and we really need to see the bond yields start to move lower, which will simultaneously also show interest rates simultaneously move lower. So again, so what now? We're going to start seeing a lot of different changes. We're going to continue monitoring mainly the labor market. Jobless claims, like I stated, actually came in better. So the yields went in higher, which usually means that rates go higher as well, okay? Again, when jobless claims came out and it dropped, less people applying for unemployment, a little bit of a scary market. So we'll start seeing a little of those changes, okay? Now, if the housing starts, industry production, jobless claims came in worse, this would be a completely different conversation for us, okay? It's really hard for me to boil this down to a really short 30 seconds. So I hope you're still catching this, because these are the three main things that I want us to concentrate on, because I know it's confusing why rates went up. Again, we want to remember specifically the bond market, as I had mentioned earlier, moves a lot faster than it does when we talk about the Fed, okay? So most of you guys usually check out our Monday market updates. We stay on top of this. We have seen inflation start to go down with the CPI report, with the PPI report. We're seeing the labor market at the same time starting to weaken, right? We saw the JOLTS report. We've seen ADP report. We've seen a lot of different changes that the Fed is really worried, truly, as they had actually stated, that they really want to make sure that there's no changes in regards to the labor market and we really fall into that recession, right? So again, we saw earlier also the 10-year went to as high as 3.74%, slightly higher than what we wanted to. So again, these are the three things that I want us to concentrate on for mortgage interest rates to go in lower. We need the mortgage spreads to get better, right? We finally see an inversion of the 10-year treasury yield and the 2-year treasury yield, which usually means that we're heading into that recession, which makes rates go down. We also have economic and labor data, again, getting softer. We need to make sure we start seeing those little changes with employment. And the last thing is we need the Fed to obviously shift their stance, as they have been, showing there's a little bit more willingness to start to help the economy stay out the recession, which is going to come from cutting, okay? So until then, really the last 2 days, in my opinion, truly made sense, given some of the economic data and where the bond market has been trading, along with some of the housing starts. I'll keep you guys updated. As always, I appreciate you guys jumping on and turning in. If you guys have any questions, please feel free to shoot us a DM or give us a call. Visit our website, gotmortgages.com.